Hello, everyone, and welcome back to the Financial Podcast. I'm Olivia, and today we're diving deep into the intricate world of apartment rents across the United States. It's a topic that touches so many lives, whether you're a renter navigating today's market, a landlord managing properties, or simply someone trying to make sense of the economic landscape. We've seen some significant shifts recently, painting a very dynamic picture of housing affordability and market trends. Let's start with the big picture. As of May 2025, the median asking rent nationwide averaged $1,633. Now, this represents a 1% decrease year over year, which is quite notable when we consider the dramatic increases we experienced in prior periods. On a month-over-month basis, we did see a slight uptick of 0.5%, which is fairly typical for this time of year, but the annual decline signals a broader trend in the market. This current median rent of $1,633 is still $72 below the August 2022 record high, indicating that while we're seeing some relief for renters, prices haven't fully recovered to their peak levels. This decline is not isolated. It's a widespread phenomenon. We've observed that more than half, specifically 28 out of the 44 core-based statistical areas, or CBSAs, analyzed recently, showed declining rents. This marks the highest number of markets experiencing price dips since September 2023, signaling a significant shift in market dynamics. The primary force driving these rent declines appears to be a surge in new supply. Apartment construction in America has been incredibly robust, hovering near a 50-year high. While renter demand remains strong, it simply isn't keeping pace with the sheer volume of new units hitting the market. This imbalance leads to a crucial consequence. Many newly built apartments are sitting vacant for months. When units remain unrented, it shifts the power dynamic in favor of the renter. This means individuals looking for apartments often have more leverage to negotiate concessions, like reduced rent for a few months or perhaps other benefits. Landlords, in turn, find themselves with less flexibility to maintain high asking prices as they compete to fill their vacancies in a saturated market. To illustrate this, the rental vacancy rate for buildings with 5 or more units hit 8.2% in the first quarter of this year, which is the most recent data available. Furthermore, less than half of newly built apartments are getting rented out within 3 months of completion, which is one of the lowest shares on record. This paints a vivid picture of the supply-demand imbalance at play. Despite these declines, it's important to put the current market into historical context. Asking rents today are significantly less volatile than they were during the pandemic era. Over the past 15 months, rents have generally moved up or down by about 1% or less on a year-over-year basis. This is a stark contrast to the wild swings observed during the pandemic, when asking rents could jump as high as 17.7% or fall by as much as 4.1% in a single year. The market has stabilized considerably in terms of price fluctuations. Now, let's zoom in on some specific markets to see where these trends are most pronounced. Austin, Texas experienced the steepest median rent decline in May, dropping by a significant 8.8% year over year. The median rent there now stands at $1,385, which is its lowest level since February 2021 and a substantial $414 below its record high from 2023. This dramatic drop isn't a mystery. Austin has been a hotbed for construction. From April 2024 to March 2025, Austin granted permits to build nearly 65 multifamily units for every 10,000 people, more than any other metro area analyzed. This aggressive building spree has flooded the market with supply, inevitably putting downward pressure on rents. Other cities also felt the impact of new supply. Minneapolis saw a 6.3% decline, Columbus, Ohio was down 3.5%, Nashville dropped 3.4%, and Portland, Oregon also saw a 3.4% decrease. Columbus and Nashville were also among the top 10 metros for multifamily permitting, reinforcing the link between new supply and falling rents. In fact, Columbus's 3.5% decline was its largest drop on record since 2019. On the other side of the spectrum, some metros are experiencing rising rents, even hitting record highs. Cincinnati, Ohio led the way with a substantial 7.4% year over year increase, reaching a record median rent of $1,460 in May. This was the largest increase among the 44 CBSAs we've been tracking. Following Cincinnati, Tampa, Florida saw a 4.2% increase, St. Louis was up 4%, Pittsburgh increased by 3.5%, and Birmingham, Alabama rose by 2.4%. These increases highlight the localized nature of real estate markets, where supply and demand dynamics can vary dramatically. Beyond Cincinnati, three other major metros recorded record high rents in May. Chicago at $1,781, Memphis at $1,274, and Washington, D.C. at $2,104. Interestingly, most of the metros experiencing rent increases, with the exceptions of Tampa, Florida, and Washington, D.C., are permitting less multifamily construction than the national average. This strongly suggests that a constrained supply in these regions is helping to buoy prices, underscoring the fundamental economic principle that limited supply combined with consistent demand drives up costs. When we break down rent changes by apartment size, we see interesting variations. Asking rents for two-bedroom apartments saw the steepest decline in May, decreasing by 1.8% to a median rent of $1,704. This was the largest drop for this size since February 2024. For 0 to 1-bedroom apartments, rents fell by 0.7% to $1,492. Meanwhile, apartments with 3 or more bedrooms experienced the smallest decline, down just 0.2% to $2,009. This suggests that the oversupply might be more pronounced in certain apartment configurations, or that demand for larger units remains more stable. Beyond just the rental market, these trends also have implications for the broader housing landscape. With rents falling in many areas and home buying costs continuing to rise, a growing number of Americans are choosing to remain renters. The typical U.S. home buyer, for instance, now needs to earn over $50,000 annually more than the typical renter just to afford their monthly housing payments. This gap has been widening considerably due to persistently high home prices and mortgage rates. This widening affordability gap between renting and buying presents a significant challenge for many aspiring homeowners. As one real estate agent noted, many individuals are finding that rental rates are simply more manageable than trying to save for a down payment and navigate high mortgage costs. They are discovering that they can secure a rental property that is often nicer than a home they could afford to purchase for a comparable monthly expense. This dynamic is partly influenced by home sellers who may be overpricing their properties, struggling to adjust to the evolving realities of the housing market. Looking at the broader economic context, the current administration, led by President Donald Trump, has often emphasized policies aimed at stimulating economic growth and deregulation. Such policies can have an indirect impact on the housing market. For example, efforts to ease regulations on construction could theoretically encourage even more development, contributing to supply. However, the current high interest rate environment, influenced by global economic factors and central bank policies, continues to be a major hurdle for housing affordability, particularly for homebuyers. These larger economic forces interact in complex ways with local supply and demand to shape the market we see today. The surge in multifamily construction that we've discussed was largely a response to the pandemic-era moving frenzy, when demand for housing, both rental and for sale, surged. Developers saw an opportunity and responded with a significant increase in building. While this construction activity has started to taper off slightly, it remains at historically elevated levels. The expectation is that as this new supply is absorbed, or as the pace of construction slows further, we might start to see a rebound in asking rents in many of these markets. This absorption process, however, can take time, especially with current vacancy rates. Another factor influencing the rental market is demographic shifts. Trends like delayed marriage, longer periods of education, and preferences for urban living continue to drive demand for rental units, especially among younger demographics. Even as more supply comes online, there's a foundational level of demand that supports the rental market. However, the sheer volume of new units has momentarily outstripped this underlying demand in many areas, creating the current tenant-friendly friendly conditions. The regional disparities we've highlighted, from the falling rents in Austin to the rising costs in Cincinnati, underscore the importance of understanding local market conditions. What's happening in one city may be completely different from another, even within the same state. These differences often reflect local economic growth, job markets, migration patterns, and, crucially, local permitting and construction activity. For investors, these insights are invaluable for identifying opportunities and risks within the commercial real estate sector. For renters, this period of increased supply presents a unique opportunity. The power to negotiate concessions, which Shahryar Bakari, as senior economist, mentioned, is a significant advantage. This allows renters to potentially secure better deals, whether through lower monthly payments, move-in incentives, or other benefits. It's a moment where being an informed consumer can truly pay off, as landlords are more motivated to attract and retain tenants. The question moving forward is how long this trend of declining or stabilizing rents will last, as the current wave of new construction eventually gets absorbed, and if economic conditions such as interest rates and inflation remain relatively stable. The market could shift again. The interplay of ongoing job growth, population migration, and future construction starts will all play critical roles in shaping apartment rent trends for the latter half of 2025 and beyond. Understanding these interconnected factors is key to navigating the financial landscape of housing. In conclusion, the U.S. apartment rental market is currently characterized by a significant increase in supply, leading to declining median asking rents in over half of the major markets. This provides a welcome respite for many renters, giving them more negotiating power. While some cities continue to see rents rise, often due to slower construction, the overall trend points towards a more balanced and, in some areas, a renter-friendly environment. We'll continue to monitor these trends closely here on the Financial Podcast. Thank you for tuning in today. I'm Olivia, and it's been a pleasure sharing these insights with you. Remember to stay informed and make wise financial decisions. We'll catch you next time.